ensure that consumer price inflation falls back to the 2% target in the medium term. And this is shown in chart 3. The blue line is the projection for consumer price inflation, conditional on the 15-day average of the market implied path interest rates to the 29th of October. That's our usual convention. Headline inflation increases to around 2.75% by the second half of next year before falling back to around the 2% target over the medium term. Alongside the forecast, the committee has also considered the two alternative cases for how the persistence of inflationary pressures may evolve. In these cases, inflationary pressures may prove to be either less persistent or more persistent than in the projection. And this is set out in more detail in a box in the report. I'm now going to add some reflections on the key judgments that we've made on the outlook for inflation. Our November projection is conditioned on government policies as announced in the autumn budget. Chart 4 shows public sector net borrowing and how it is projected to change relative to the previous March projection by the Office for Budget Responsibility. In the autumn budget, the path for public sector net borrowing is higher than it was in March, but the chart on the left also shows that the difference is more pronounced in the first than in the future years. Public sector net borrowing is still projected to fall significantly over the forecast period. We provisionally expect the measures announced in the budget to boost the level of GDP by around 0.75% at their peak in a year's time. This reflects the stronger and relatively front-loaded paths for government consumption and investment, more than offsetting the impact on growth of higher taxes. Overall, fiscal policy is still expected to tighten over the forecast. But all else equal, the changes announced in the budget are expected to reduce the margin of spare capacity in the economy over the forecast period. The marginal effects on our inflation projections from the autumn budget are shown in chart 5, which has just come up. Combined, measures push up on inflation by just under 0.5 percentage point at their peak. That's the white line. The extended freeze on fuel duty pushes down on inflation over the next fiscal year, that's the orange bars. But as it is assumed to rise thereafter in line with announced government policy, fuel duty then pushes up on inflation from the second quarter of 2026. Other measures directly push up on inflation over the first year, that's the purple bars. Now, there are different ways in which the increase in employer national insurance contributions could play out in the economy. It represents an increase in the cost of employment. There are at least 4 margins of adjustment. Firms could pass on higher costs to consumer prices, or firms could absorb the increase through lower margins or higher productivity. Firms could increase wages by less, or firms could respond by reducing employment. Now, let me be clear, public policy measures of this kind serve other objectives, and it's not for us to opine one way or the other. What we must do is respond to any consequences for inflation in order to meet our 2% target over the medium term. Now, we will get information on how the consequences for inflation evolve over time. A gradual approach to removing monetary policy restraint will help us to observe how this plays out, along with other risks to the inflation outlook. Developments in the UK labour market continue to be very important for assessing developments in inflationary pressures. There are mixed signals from the data. Wage growth remains strong relative to our models, perhaps reflecting some continuing real wage catch-up in a still relatively tight labour market. As chart 6 shows, annual growth in private sector regular pay, that's in blue on the left-hand side, has eased to 4.8% in the 3 months to August, down from a peak of just above 8% in mid-2023, and indeed in line with our expectations in August. A normalisation in inflation expectations and easing in labour market tightness have supported that moderation in pay growth. Consistent with the slowing in the official measure, a bank staff indicator model of underlying pay growth has also declined in recent quarters, pointing to underlying wage growth of around 4.8%. That's the orange line. Along with some, but not all, outside surveys and measures seen on the right, this points to a gradual but progressive move down in wage growth towards levels consistent with the 2% inflation target. The bank's agents also suggest that wage settlements could continue to come down, perhaps to around 2 to 4% next year, compared with 6 to 6.5% in 2023. And I would add that this is the story that I've heard consistently when I've joined them recently on visits to businesses in different parts of the country. But two further observations should give us cause to reflect. First, 1 year ahead expectations for wage growth of firms in the bank's decision maker panel seem to have stabilised at a higher level of around 4% in recent months. Second, the evidence, such as it is, points to the quantity side of the labour market remaining relatively tight while showing some loosening. Both of these observations could point to lingering persistence in wage pressures beyond what we're assuming in the projection. So let me conclude. There's been continued progress in disinflation, particularly as previous external shocks have abated. So at this meeting, the committee voted to reduce bank rate to 4.75%. Based on the evolving evidence, a gradual approach to removing policy restraint remains appropriate. Monetary policy will need to continue to remain restrictive for sufficiently long until the risks to inflation returning sustainably to the 2% target in the medium term have dissipated further. The committee continues to monitor closely the risks of inflation persistence and will decide the appropriate degree of monetary policy restrictiveness at each meeting. And with that, Claire, Dave and I will be happy to take your questions. Thank you.
Right. We'll start today with Larry for his last press conference, and then we'll go to Faisal.
Thank you. Governor, is the message from this report that as a result of the budget, interest rates will stay higher for longer than they otherwise would have done?
Well, let me begin by echoing what Katie just said, if you don't mind, Larry, on a personal note. I know this is your last... I don't know how many of these you've done, but it must be a lot. Too many. No, that can't be true. There's no such thing as too many of these. But look, Larry, I think we all want to join before I answer the question together. And A, thank you for all you've done for British economic journalism, and B, wish you all the best for the future. It's been a pleasure working with you. What? And you are, of course, the first person ever to get applause in this press conference, because we will never get it. So all the best, Larry. So on the question about the budget, look, we've set out the picture. I would say, look, we've cut interest rates today, so I mean that, of course, is actually obviously significant in the context of the news. You'll see that the view we've reached. So the first thing I'll say, yes, there is some upward effect on inflation, but the path of inflation, as we've set out, we think returns to the target. By the horizon that we look at, and that is what has given us, in a sense, support for cutting rates today. But what I would say, and I'll just re-emphasise what I said earlier, is that there's obviously a lot that we will learn about the effects of the budget as they pass through. I think it's important that we have time to do that. We all have time to do that. And so that underlines again the message we've given today. We'll need to see how these effects pass through. You saw I laid out quite carefully the channels through which the impact, for instance, on employment costs can work. They are obviously quite different channels, actually. We can have combinations of those. We no doubt will have combinations of those channels. And we'll want to observe very closely how that works. Our agents are fully primed to go out and start asking about it, and we'll want to get that information. Do you want to?
Can I add one thing just on? I mean, the market curve always moves around, and as we flag in the minutes, I mean, in the run up to the budget, it was being pushed up by US data developments. That's quite common. There has been movement since the budget, but we're seeing we're seeing quite a lot of movement in the curve at the moment, given the events that are taking place either domestically or globally.
So I can add a bit about the detail, if you like, on the impact of the budget as we have seen it. You can see in our projections we've been quite clear. So obviously, the front-loaded fiscal loosening that the budget represents means we've got higher inflation by 0.3 percentage points at the end of next year, 0.4 the year after, 0.3 the one after that. That's quite similar to what the OBR have. Actually, they've got a slightly different profile because we, have slightly different views on the multipliers. They're slightly more front-loaded. But you can see there the impact of the budget on inflation, and that is, of course, set in the much wider context of what we've seen on inflation in terms of actually the numbers coming down and coming down by more than we expected recently, but also on the inflationary pressures that we see, and those also coming down, which explains basically the decision today.
Can we go to Faisal? Yeah.
Faisal Islam, BBC News. Just to reiterate that point, should people at home, should households expect mortgage rates, for example, to be higher than they otherwise would be, even a bit, as a result of the budget? And are you happy that the market response post-budget has been orderly?
Well, I think on mortgage rates, we've actually, we've seen some reduction in mortgage rates since the August report. Obviously, we've cut rates today, so we'll see how that feeds through. But obviously, how it feeds through for most mortgages now is depends on how the curve moves, because most mortgages obviously are priced off the swap curve because they're mostly fixed rate mortgages. So I don't think that it's sensible to conclude that the path of interest rates will be particularly different in that respect. And of course, let's be very clear, we don't set out an expected path ourselves, because that, we respond to the news as we see it and form our views as we see it. So I would emphasize the point I made, that the profile that we have of inflation starts lower, does go up, but let's be clear when we talk about going up. I mean, these are a different order of magnitude of numbers compared to what we've been talking about in press conferences here for for recent years, and it's an altogether better magnitude in that sense. But then the key point is that it comes back down to target, and we think sustainably within the forecast period. So that's
just to reinforce Andrew's point. I mean, the curve. What we've seen, the 2-year rate for a 75% LTV mortgage has come down by 78 basis points since May. So that's in chart 2.7 that shows you what's happened to all the savings and borrowing, all the key savings and borrowing products. And as Andrew was saying, that's been, the reference rate for that important mortgage is the OIS rate, which has also come down over that period. But
I mean, I think just on the second part of your question, Faisal, and just looking at market movements over the last week or two. To start with, I think if you go back to the beginning of last week, I think the market was positioned long at the sort of shorter end of the sterling curve, so it was positioned for lower interest rates. I think what you saw sort of in the latter part of last week was some adjustment. There was some closing of those positions as the curve moved up. Not surprising, because those positions have stop loss orders on them typically, and those stop loss orders can be quite highly correlated. I think that process happened. So we've had that process. But then, of course, what happened was, and this was really from Friday afternoon onwards, that the dominating, if you like, event was the US election, not anything going on in this country. And the curve obviously has been, curves have been moving around quite a lot over recent days, but I mean, it's quite clear that, that's been the more dominant factor. And I think what we were picking up from market intelligence was that there was quite a reluctance in the market to take positions while the outcome of the US election wasn't known. So you did get, I think, these two things coinciding. I think there was some closing out of positions in sterling into a market which was increasingly, certainly from Friday afternoon onwards, not really wanting to take positions given the uncertainty of the outcome of the US election. So I think that's the context. But I think now, look, you look at the market today, it's a lot more. It's pretty settled today. So
and throughout the period, because obviously you'd expect us to keep a very close eye on monitoring. We've been seeing orderly market conditions.
Right. Let's go to Helia and then Sam, please.
Helia Ebrahimi, Channel 4 News. Governor, what's your message to households today? You seem to be saying that you're cutting interest rates because inflation is coming down. In fact, it's coming down faster than you expected. But You're also in the book saying that inflation isn't returning to target now until the middle of 2027 compared to the middle of 2026, which you thought before the budget. On balance, has the budget made your job harder?
So the message let's take two parts to the message. The first part, as you said quite rightly, is, look, we've got good news. The disinflation process, as I showed in the first chart, it not only continues, but actually has been faster than we expected. And not just faster over the last year, faster since we were last here in August, and that's good. And it's encouraging. There is greater uncertainty out there. Now, I would point to two things. I mean, first of all, there is greater global uncertainty, without doubt. The second thing to say is that there are domestic uncertainties, and I pointed to two of them in my remarks. One was just to emphasize we need to obviously see how the budget measures pass through in terms of their economic effects, and then I pointed again, as I have done in the past, obviously to the labour market and how the adjustment of the labour market continues, and those things obviously are related as well. So it's a point about uncertainty, and that's why, as you'll have observed, the word gradual once again appears in our language.
Thanks, Sam Fleming from the Financial Times. In Box D, you talk about unexplained strength in import prices in the report and its importance for inflation. In that light, could I ask you about the result of the US election and the potential for higher protectionism, trade barriers, tit for tat, retaliation around the world? How do you think about that?
Sure.
In terms of upside and downside risks, especially in light of
yeah, I mean, I'm sure Claire wants to come in, but let me make 2 points to start with. First of all, the point we were making or are making on import prices is not at all about the US election. It's really based on an observation in the data that the relationship between world export prices and UK sterling import prices has not moved as we expected. In a sense, they've not really moved together. We've seen some divergence with stronger UK import prices than we would have expected based on world export prices, and frankly we've adjusted our assumption to reflect the fact that we don't see any evidence of that really sort of coming to a conclusion. On the second point about the US election, can I just make this point? First of all, we always respond to announced policies, and that's true in the world, it's true in the UK, not to stories about what they might be. So we're not going to respond to anything. The second thing I'll make, just to be very clear on this, we work with all US administrations, more obviously on the financial stability side than the monetary policy side, because that's the nature of financial stability versus monetary policy. But we work with all administrations. We will look forward to working with the new US administration. We worked with the previous Trump administration. We work with the current administration, and that's our good job. I mean, that's what we do. We do it without any, if you like, sort of presumptions, and we will do that constructively.
Yeah. Not much to add on the import box and the global export price, except to sort of reiterate your point that what we've done here is made a sort of change in our judgments, reflecting what we're seeing in the data, particularly. And the effect is not sort of insignificant on inflation further out.
Can we go to Sue and then Joel, please?
Hi, Sue Chan from The Telegraph. Just following on from Sam's question, I wouldn't dare ask you a question about policy, but just about the structure of the UK economy. How exposed is the UK economy to a potential global trade war? And given the UK exports more services as opposed to goods to countries like the US, are we more immune?
Well, I mean, the UK is an open economy. That's one of the things we always say about the UK economy, and it's true. It's an open economy. Of course, many economies are open, so we're not unusual in that respect. So, look, I think we will have to watch this very, very close, as we will. We'll watch it very closely. As I said, I'm not going to make any presumptions about what will happen, because I don't think that's either A, consistent with our policy remit, or B, wise. Frankly, I think let's see what happens. And there will, I'm sure, be a very open dialogue between both our government and the US administration. And I say where appropriate, just to reiterate the point, we work very closely with US administration.